Now friends, over here, so the question says like this, that say we want to again expand our business, and this time we require an amount of 30 lakhs. We are considering say raising of the 30 lakhs by one of the two financing. Either entire 30 lakhs will be financed by way of the long-term loan, or otherwise for this 30 lakhs you will go for the combination. The combination will be like equity share capital plus debentures. Like that, so there is a combination of this two. In case of the equity share capital, I have explained you orally, 75,000 into 20, so that comes to 15 lakhs. Out of 30 lakhs, 15 lakhs is subtracted, so the debentures will be again 15 lakhs. This is the way you are required to do the segregation. That's also, I think that's not something which is difficult. And over here the first option is entirely 30 lakhs of the loan. So financing plan 1 and financing plan 2. For these two financing plan, importantly this time you can see that the questions provides that you are required to make the selection of the financial plan based on the market value of the equity share. So this time what you are required to do, my dear students, you are required to make the computation of market price of the equity share for first financial plan and for second financial plan. How to make the calculation of the market price of the equity share? Listen carefully what I am going to speak. You can see that over here some information is provided to us based on which you are required to compute the price earning ratio. You are required to apply the price earning ratio. There is one formula that we have in our ratio analysis chapter called price earning ratio. It is MPS upon EPS. This is the formula that we have of the PE ratio. So we can say that now MPS is equal to EPS into price earning ratio. So as what we do normally, we'll make calculation of EPS and the same will be multiplied with price earning ratio. EPS into price earning ratio, multiplication of both of them would be MPS. That is the way for each of the plan we'll make the calculation of earning per share. Now friends, how to make the calculation of EPS, we already have discussed it. Are we expanding the business? Yes, we are expanding the business by 30 lakhs. So are we going to earn something more? Yes. We understand that say apart from the existing EBIT, this 30 lakhs will also be able to give say some additional earning. The question is providing the information like this, that the company expects rate of return on the funds employed to be improved by 3% because of the modernization of the plant. Like that information is given. So we understand that say, suppose, just for time pass I am telling you, suppose the current rate of earning is 14%, for example 14%. Let us assume that the current capital employed is an amount of 100 lakhs and your operating income is an amount of 14 lakhs. What you are going to do, you are going to expand your business. By how much amount? You are going to expand by 30 lakhs. So this 30 lakh rupees of the funds will be able to give you some earning. The question says that on this 130 lakhs, listen carefully, on this 113 lakhs, you will earn at the rate of 17%. From where the 17% comes, you can see that say right now rate of earning is 14. 14 plus 3, it comes to 17. So we understand that say you will earn at the rate of 17% on entire 130 lakhs. That is the way you are required to make the computation of the earning before interest and taxes for first plan and second plan. I am repeating the last point. The question is providing the information that once you will expand your business, then in that case your return on investment will increase at the rate of 3%. So for example, just for time pass I am saying this. For example, your current capital employed is an amount of 100 lakhs. You earn an amount of 14 lakhs. It means that your current return on investment is 14%. You earn at the rate of 14% right now, and that 14% return will increase by 3%. So from 14 it will increase to 17%. Your total investment, your total capital employed will be an amount of 130 lakhs. How 130 lakhs? 100 lakhs is the current capital employed. I am just taking assumed figures. 100 lakhs is the current capital employed plus 30 lakhs, that is the amount by which you are going to expand your business. So on this 130 lakhs, you will earn at the rate of 17%. This is what we understand is the EBIT once you will expand your business. I am giving an explanation of this price earning ratio once again. This time language of the question says very clearly that say you are going to select the financial plan with which the market price of the equity share is comparatively more. Further, the question is providing over here the information about the price earning ratio. In our ratio analysis chapter, there is a formula like this: price earning ratio is equal to MPS upon EPS. We want to calculate MPS, so it will be computed as EPS into price earning ratio. This is the formula which is required to be applied. So what will happen for the first financial plan as well as for second financial plan? We will make the calculation of the earning per share for the first plan and for second plan. Some information is given to us based on which we'll compute the price earning ratio. Multiplication of this two, you can see, is market price of the share. And between these two financial plans, financial plan which is having more MPS will be selected. So we understand, say, first of all, let us have focus on the EBIT. So students are requested to pay attention. Step number 1, calculation of EBIT after expanding business. How we will calculate the same? It is working out number 1. We understand that, say, we'll make the calculation of existing term loan, working out number 2, we'll make the calculation of the debentures, third will be capital employed, and fourth will be calculation of return on investment slash return on capital employed presently, and fifth, calculation of EBIT after expansion of business. So the first step will be calculation of the EBIT after expanding. For that, say, there are 5 things to be done. First, existing debentures, existing long-term loan, capital employed, then return on capital employed, and after expansion, what will be the EBIT, that calculation. Please write down this step number 1 and try to do working note number 1 to working note number 5 on your own. So over here, so these are the 5 working notes which we are required to prepare to make the computation of the EBIT after expansion of the business. Yeah. Write an answer. Working note number 1. Calculation of existing long-term loan. How to make the calculation? Let us see. Interest is equal to long-term loan into rate of interest. So long-term loan is equal to interest divided by rate of interest. The amount of the interest is given to us is an amount of 2,70,000 and the rate of interest is 12%. So 2,70,000 divided by 12%. That is the way the long-term loan will be calculated. So the amount of interest comes to 22,50,000. That is the first working note for the long-term loan. Working note number 2, calculation of debentures. For the debenture, here is the information given to us. We understand that, say, answer will be found as I is equal to PRN upon 100. That is the way the debentures will be found. The amount of the interest is 2,70,000. What is the principal amount that we do not know? The rate of interest is provided to us as 10%. Sorry, this is 360. This is 10%. And the time period is starting from 1st of August. So August, September, October, November, December. So 5 months of this year and 3 months of the next year. So it would be, that is 5 plus 3, 8 months. So this is the way the principal amount will be calculated. Okay. So the principal amount is 3,60,000 into 100 divided by 10 into 12 divided by 8. So 3,60,000 into 10 divided by 100 into 12 divided by 8. That comes to 54 lakhs. Next is the calculation of the capital employed. Working note number 3. Calculation of capital employed. In that, equity share capital. We can see that, say, there are 6,30,000 equity shares of rupees 10 each. That comes to an amount of 63 lakhs. So 6,30,000 equity shares of rupees 10. Next is the reserves and surplus, 60,50,000. There is no information for the preference share capital, so we are ignoring it. Then long-term loan that we have found 22,50,000. Then debentures 54 lakhs. This is the way we are required to find the answer. 63 lakhs plus 60,50,000 plus 22,50,000 plus 54 lakhs. That comes to 2 crore, that is 200 lakhs. This is the capital employed. Working note number 4. Calculation of current return on capital employed / return on investment. So we are required to find the current, that is the present one. It is 28,80,000. So over here it is EBIT divided by capital employed multiplied with 100. So it is 28,80,000 divided by 200 lakhs into 100 for getting answer in percentage term, and it comes to 14.4%. So this is the current return on capital employed. Next, last working note. Calculation of EBIT after expansion. We understand it is capital employed into return on investment. So 200 lakhs plus 30 lakhs. Plus 30 lakhs. It is overall 230 lakhs into 14.4 plus 3. The return on investment, or it is given a name as return on capital employed. So 230 lakhs into 17.3%. Why? Because the language of the question speaks like this, that the company expects that the rate of return on the funds employed will be improved by 3%. So it will be 17.3. So 230 into 17.3%. That comes to 39,79,000. Please write an answer. Sorry, it is 17.4. Sorry. So 230 into 17.4%. That comes to 40,02,000. I'm sorry to all of you. Please write down answer. Write down next, step number 2. Calculation of current price earning ratio and price earning ratio for each financing option. So friends, we are required to make the calculation that say what is the current price earning ratio, and we are required to make the computation that say what would be the price earning ratio if at all we raised additional financing by way of debentures, or say we raised the financing by combination of the debentures and equity shares. The language of the question speaks like this. Listen carefully, all of you. The language of the question says that the company expects rate of return on the funds employed to be improved by 3% because of the modernization of because of modernization. And if debt equity ratio, that is say, see carefully, a specific formula is given by them, debt upon debt plus equity exceeds 45%, then the price earning ratio will go down by 15%. So what happens, let's say we are required to make the computation like this. Everybody is requested to pay attention. We will make the computation like this. Working note number 1. Existing price earning ratio. Working note number 2. Amount of debentures comma for second plan, because in case of second plan what will happen, we are going to have the combination, that is the reason. Third, debt equity ratio for each plan, whether we are going for the first one or we are going for the second one. In both the cases, what would be the debt equity ratio, that we will compute. Fourth, price earning ratio based on debt equity ratio. In a way that say we are required to make the computation of the, that is, we'll make the adjustment of the price earning ratio based on the debt equity ratio for the first one and second one. It means that say if at all the debt equity ratio increases, then the price earning ratio will fall down. If at all the debt equity ratio does not increase, does not exceed 45%, the price earning ratio will remain same. That is what we understand. Write down working note number 1. Calculation of current price earning ratio. Please tell me answer of the current price earning ratio. Please write an answer. Earning after taxes is already provided to us an example. It is 15,75,000. Divided by number of equity shares. We can see that the number of equity shares are 6,30,000. So earning after taxes divided by number of equity shares will give EPS. So 15,75,000 divided by 6,30,000. That is 2 rupee 50 paise. Market price of the equity share is rupees 24. Price earning ratio, it is MPS upon EPS. 24 divided by 2.5. That is 9.6 times. Please write an answer. So here is the MPS information is given to us and number of shares are given to us. Now next is the working note number 2. Calculation of amount of debentures to be raised for second financial plan. What is the amount of the funds? The amount of the funds is 30 lakhs required. That is divided into two parts. One is the equity financing. We can see that says 75,000 equity shares are issued at the rate of 20 rupees. That comes to an amount of 15 lakhs. So out of 30 lakhs, 15 lakhs is by way of equity financing and the remaining is debentures. That is an amount of another 15 lakhs. And this is calculated as balancing figure. That is the debenture financing. The next is the debt equity ratio to be calculated. So working note number 3, calculation of debt equity ratio. We have been provided with the two plans. One is long-term loan and another is the debt in equity. So the first one is the long-term loan and the next is the combination of debt and equity. I want you to tell me the answer of the debt equity ratio for the long-term loan option. Let us see how to do answer. We understand the existing financing is going to remain same. So we understand the existing long-term loan we have it is an amount of 22,50,000. Then we understand the existing debentures that we have. It is, I think the 54 lakhs. That is of course not going to change. Now you raise the additional financing by way of the long-term loan. So over here, so raise the entire funds by way of long-term loan 30 lakhs. So additional long-term loan an amount of 30 lakhs. So we'll get a kind of numerator. So I'm writing over here total debt. That is 22,50,000 plus 54 lakhs plus 30 lakhs. That is 106.5 lakhs. Okay. Now we understand the existing equity share capital. So this 6,30,000 into 10, that comes to 63 lakhs. Reserves and surplus 60 lakh 50,000. In the first option, we understand that say there is no additional equity financing. So I'm writing over here debt plus equity. In that 106.5 lakhs plus 63 lakhs plus 60 lakh 50,000, and the answer is 230 lakhs. Okay. Next is debt equity ratio. How to find answer? It is debt upon debt plus equity. What is the debt financing? 106.5 lakhs divided by 230 lakhs into 100 for getting answer in percentage term. So 106.5 divided by 230 into 100. So it is 46.30%. That is what we understand. Okay. So now in case of debt and equity combination, existing long-term loan is going to remain same, 22 lakh 50,000. Existing debentures will remain same, 54 lakhs. There is no additional long-term loan. Instead of that, so there will be debentures. So here I am writing additional debentures. The amount of the debentures is an amount of 15 lakhs. Next, so the total amount of the debt financing will be 22 lakh 50,000 plus 54 lakhs plus 15 lakhs. That is 91 lakh 50,000. Existing equity share capital will remain same, 63 lakhs. Reserves and surplus will remain same, 60 lakh 50,000. Then there will be additional equity share capital. We understand that say, as per the given information, 75,000 shares will be issued at the rate of 20. So we understand it is 75,000 into 20. That comes to 15 lakhs. Okay. So now we understand that say again 91 lakh 50,000 plus 63 lakhs plus 60 lakh 50,000. $91 lakh 50,000 plus 63 lakhs plus 60 lakh 50,000 plus 15 lakhs. Yes, it is coming once again 230 lakhs, and it is supposed to become, it is supposed to be this only. Debt financing is 91 lakh 50,000 divided by 230 lakhs into 100 for getting answer in percentage. So 91.5 divided by 230, that comes to 39.78%. Now importantly, I am writing price earning ratio. Friends, in the second option, the debt equity ratio does not exceed 45%. So in that case, the price earning ratio will remain same, that is 9.6 times. In the first case, the price earning ratio will fall, that is 9.6 minus 15%. So 9.6 into 0.85, that comes to 8.16 times. That is the way the price earning ratio is required to be mentioned. The question is, there is one query, sir, why are we using debt equity ratio, debt plus equity as denominator and not only equity for calculation of the debt equity ratio? So student is asking a question, sir, when we make the computation of the debt equity ratio, normally we use the formula debt upon equity. So if at all we use this kind of formula normally, then over here, why do we have a formula like this? See over here, first thing that we have to understand is that basically we are working for a company. We are a consultant. So if at all the company wants to consider debt equity ratio in a special manner, then in that case we have to follow that. In a way that we just have to follow the instruction that they have provided for making calculation of answer. If at all the question would not have given any specific formula for making calculation of the price earning ratio, then in that case you are correct. We will apply the formula which we generally do, which we generally apply for making calculation of answer. Yeah. Now we have made the computation of the price earning ratio also, and we have made the calculation of the EBIT also. So now step number 3. In that, calculation of earning per share and market price of share for each of the financing option. So the first one is provided to us as long-term debt, and another is equity and debentures. So long-term debt, and the other option is equity plus debentures. So for both the options we are required to make the calculation of EPS multiplied with the price earning ratio, MPS. For long term debt, I want you to tell me MPS. We'll start with the EBIT. We can see that we already have found EBIT, friends. It is an amount of 40,02,000. So it is 40,02,000. Less interest. In that we have the long-term loan, debentures and additional long-term loan. For long-term loan, 22,50,000 into rate of interest is 12%. Plus debentures, in that 54 lakhs into 10%. Plus additional 30 lakhs for that the rate of interest is provided to us as 13%. This is the way the total interest amount will be found. So we understand that over here 22,50,000 into 12%. So the amount of interest will be 2,70,000. So for this it is 2,70,000. Then 54 lakhs into 10% is 5,40,000. And 30 lakhs into 13% comes to 3,90,000. So what will happen? 2.7 plus 5.4 plus 3.9, that comes to 12 lakhs. EBIT minus interest is EBT. It is 28 lakh 2000. Income tax rate is 30%. So earning after taxes is 70%. So 28 lakh 2000 into 0.7. So 19 lakh 61,400. That is earning after taxes. Importantly, friends, over here we understand that in the previous year, which has just been completed, 31st of March 2022, the debentures were issued like on 1st of August. So we made the payment of interest only for 8 months. But for the next year, because we understand that say we are expanding the business and we are making the computation for the next year. So for the next year you have to pay interest for the entire year. So the amount of interest will not be 360, the amount of the interest will be 5,40,000. So earning after taxes divided by number of shares. It will be 6,30,000 because there is no change in the number of shares. It will give EPS. So we understand that it is 3.1133. Price earning ratio. In the first case it is going to remain, I think that it is going to fall down to 8.16 times. And then we'll compute the MPS. 3.1133 into 8.16, that comes to 25.40. 45. That is the MPS in the first case. Similarly, we will do for the next one. Next, the amount of the EBIT will remain same, 40 lakh 2000. Interest for the existing will remain same, 2,70,000 plus 5,40,000 plus additional debentures will be issued, an amount of 15 lakhs. And what is the rate of interest? Rate of interest is 11%. So plus 15 lakhs into 11%. That is the way we will compute the total interest. So 15 lakhs into 11%. So 1,65,000 plus 2,70,000 plus 5,40,000. That comes to 9,75,000. Which is deducted from 40 lakh 2,000. So it is 30 lakh 27,000. Into 0.7, 21 lakh 18,900. Number of equity shares, 6 lakh 30,000 right now plus 75,000 additional shares. That comes to 7 lakh 5,000. So it is 3.0055. Price earning ratio is 9.6. So the answer is 28.85. That is where the MPS can be found. So between this two, the second financial plan is better. Right an answer? The company is advised to select second financial plan. Full stop. Yeah, this is a question asked in May 2019 examination for 8 marks. So this kind of questions can be there in examination too. Okay, write down a note for the answer. First point, in this question, we have to decide which financial plan, comma, the company should select. Full stop. Second point, for the purpose of decision making, comma, we are calculating market price of equity share comma for each plan. Third, importantly, we have to compute debt equity ratio by using formula given in the question and with that price earning ratio will be adjusted. Full stop.